If you ask other finance YouTubers, we can all agree that Dave Ramsey has helped thousands with their finances. I'm not here to bash on his teachings. He has taught me stuff that I never knew about, but I don't believe his advice is a one-size-fits-all. In this video, I will cover why I no longer follow him and just take his information with a grain of salt. The first reason why I had to stop listening to Dave Ramsey is the use of credit cards. Papa Dave, he hates credit cards and does not believe in using them or even care about your credit score. Credit cards are something that I have used ever since I was able to apply for one when I was 18. When I was fresh out of boot camp, nobody taught me about financial literacy. I knew that credit cards were just good to have because you can build credit. I knew that if I had not built any sort of credit score, that buying any car would be more expensive than it already was. When I discovered Dave about 5 to 7 years ago, I took a little break from credit cards for a short while since he kept preaching that credit cards are the devil. He kept saying there's no reason to use them since you can get out of control. After a short sabbatical from credit cards, I started using them again. I would sign up for a credit card every few months so I could hit that minimum spend and get that sign-on bonus. I would then use those points for travel, hotel stays, and all the perks that come along with those credit cards. So despite having the fact of using credit cards for over 10 years now, I had never had to pay any interest. I was able to take advantage of all the benefits of a credit card, all with a bit of discipline. I can't tell you how many trips I have taken with my wife to go to my mom's house during Christmas, traveling overseas, or just having a little nest egg of cash just from credit cards. One of my credit cards have an annual fee of $49 a year, and every single year I get a free night stay. For the past couple of years in a row, I've been staying at the Intercontinental. These rooms generally cost around $200 to $300, so for 50 bucks, it's a nice little staycation or whenever we needed a room. With me working all the time, having the ability to stay somewhere for cheap is definitely a big plus for me. He's talking to the individuals who are financially illiterate, pile high in debt, and lack self-control. If you have been a listener to his show, I'm pretty sure you have heard stories of people calling in with loads of credit card debt. Some credit card interest rates can range anywhere between 15 to 25%. So for example, if you have a credit card balance of $1,000 with an interest rate of 20%, if your minimum payment is $35 per month, it will take you 40 months to pay it off. The total interest that you would be paying would be around $369. Dave Ramsey thinks that most people are undisciplined and lack self-control. I beg to differ, because this can all be self-taught. If you were to treat a credit card just like cash, meaning that if you're not able to pay for the item in full right away, then it is best for you to wait until you can, so you can just reap the full benefits of the credit card. The goal of a credit card is a tool to gain a little bit of passive income, take advantage of its perks, and its protections. The next reason why I stopped following Dave is his approach to investing. What Dave tells you to do is to not even think about investing or retirement until you have paid off your debts, managed your home, and established an emergency fund. To make matters worse, if your employer offers a 401k match, he does not even want you to put any money into this account. A 401k match is a surefire way to get a 100% return on your money no matter what, just like this. This is free money that will continue to grow and compound as the market grows. So even if you are working to pay off your debts, if you are able to put a small percentage of your paycheck every single month for the employer match 401k, you should definitely take advantage of this. Time is the only level playing field that everyone has. This is something that we cannot get back. If you're familiar with long-term investing, the earlier that you start investing, the more time your money has to grow. But this is not the only thing that I disagree with about Dave when it comes to investing. Dave Ramsey's investment strategy is very misleading when it comes to asset allocation. If you are not familiar with what asset allocation is, this is which assets that you place your money in when you want to invest. Dave recommends investing into mutual funds from your employer-sponsored retirement savings account or IRA in growth and income, aggressive growth, and international funds. Out of these 4 funds, 3 of them have roughly the same asset classes. If you were to invest into growth and income, and aggressive growth, you're investing into the same companies with a lot of overlap. So buying into these funds are not all that diversified. If you truly want to diversify, then you would want to invest into some small cap stocks, bonds, commodities, and even real estate. So that brings me to today's sponsor, Wealthfront. For those who don't know who Wealthfront is, they're an automated investment platform that utilizes software to create a globally diversified investment portfolio to help you grow your money for the long term. There's plenty of data out there that shows that investing into a well-diversified portfolio with low-cost index funds is one of the best ways to put your money to work, and Wealthfront does exactly that. They start off by asking you questions about your goals, risk tolerance, investment preferences, and then they take care of the rest by automatically building you a portfolio tailored to your risk tolerance. They will also handle managing the portfolio for you, so you don't have to worry about rebalancing and you can just set it and forget it. They also have a strategy called tax loss harvesting that could lower your tax bill without any extra work on your end. and 96% of all of their clients using their classic recommended portfolio have had their advisory fees covered by the service alone. Additionally, Wealthfront has just added hundreds of new investment options, so you even have more control to build your portfolio that you want. And just recently, they released their new socially responsible portfolio that's diversified and tailored to your risk tolerance, so you can invest the way that you want with just a few clicks. If you want to learn more about Wealthfront or get started today investing with as little as $500, use the link down below in the description to get a special sign-up bonus. Now moving on to his recommended 15-year mortgage. There are many financial advisors who recommend your mortgage payment should not be more than 25% or even up to a third of your take-home pay. Currently, I live in San Diego, where the median home sells for roughly around $860,000. Even with the housing shortage everywhere in the US, within the last year, San Diego has risen almost 20%. So let's just say that I wanted to buy the median house. With 10% down, my mortgage would be around $5,700 for a 15-year at 2.3%. But if I were to get a 30-year loan at 3.1%, my monthly mortgage would be around $3,900. So if I were to keep my 15-year mortgage payment to less than 1/3 of my take-home pay, I would have to make at least $17,000 after taxes. If I wanted to keep it less than 25%, then I had to take home closer to $23,000 a month. So to afford a 15-year mortgage on a median house in San Diego, one would have to be the top 10% of earners in California, possibly much higher, given the fact that I did not even calculate gross salary, and this is only based on take-home pay. So most people would not be able to get a 15-year mortgage with a monthly income of less than 25% of their take-home pay. Well, I do know that this is possible out there for people to find a home like this, but for the majority of Americans, this is unrealistic. I know that there's gonna be a lot of diehard Dave Ramsey fans in the comments section saying that I'm stupid and how I'm a complete idiot for being against Dave Ramsey, so I am ready for it. Now, this brings me on to my next topic, which is paying off your mortgage early. Before I get into this topic, I had never met a person who is sad about owning their home and not having a mortgage payment. I get it. Since you don't have the liability of a mortgage payment, this frees up money for other financial decisions. But before you decide to pay off your home early, you really gotta run the math. For me, it does not make sense from a mathematical standpoint. Given the current interest rates, which are roughly around 3%, with any money that you have left over, rather than going towards the home, investing into the stock market would definitely get you a better return. I understand that homes within the past couple of years have risen like crazy, but this is not the norm. Even though I'm not a financial advisor, it does not take a genius to figure this stuff out. When you take a look at an index fund like the S&P 500, the data shows us that you'll make around 7 to 10% per year on your money. Even though this is hypothetical, if you were to continue to pay off your mortgage for 30 years, plus any extra money invested into the stock market, the total value of your home and stock investments would outweigh the amount that you were to pay off your mortgage early and invest the remaining mortgage payment into the stock market. The reason why this is due to compound interest and time. So no matter who you ask, some will prefer to pay off their house early so they can have that peace of mind. Someone will be okay to take on the added risk to further increase their net worth. So I know this is gonna be a little bit different for everyone. This is not gonna be a plan that fits all type deal. If you follow Dave Ramsey's baby steps, you should know that the first thing you should have is at least $1,000 as an emergency fund and spend everything else on remaining debt. The first time that Dave released his book was back in 1988. This is where he preached this idea. $1,000 back in 1988 is equal to roughly around $2,300 in 2021. So when Dave pitched his idea, due to inflation, the original $1,000 currently does not hold as much weight. I get it though. Having a buffer is much better than not having anything at all. After you have paid off your debt, this is when you want to build a real emergency fund, which is 3 to 6 months of living expenses. In my own personal opinion, the first step of an emergency fund should be at least 1 month of living expenses. This will make me feel a little bit more warm and fuzzy inside, knowing that I have at least 1 month to get back on track. We all know that debt is bad. If you listen to Dave, I'm pretty sure that you heard this a million times, but there are differences in the types of debt. The obvious is high interest debt, such as consumer loans or credit cards, where interest rates can range anywhere between a few percent all the way up to 20-something%. It is common sense to try to tackle those first, since they will end up costing you the most money in the long run. My old drill instructor always said, common sense is not all that common. But the majority of people understand that credit card debt is bad and they should pay those first. Then there are ways of leveraging debt that can even make more money. If done correctly, you can definitely be financially free much sooner than later. My general recommendation is to take care of debts with the highest interest first, then work your way down. This way you save more money on interest and take advantage of inflation. For loans that have a low interest rate between 0 to 3%, might as well pay them off as agreed in the terms. With the help of inflation, low interest loans keep your costs consistent. Dave does have a lot of good information out there, but it's outdated. Plus the guy has been a millionaire for such a long time, he may be out of touch with reality. If you're not with him and you're against him, which is very polarizing, and I know that this works with any type of following. But at the end of the day, personal finance is personal. learn from others that can help you out, then mold it to what works for you. Even though I consider myself pretty practical and logical, Dave does tend to focus more on human behavior. He does have a simple step-by-step process and help thousands, but for the most part, I cannot follow Dave Ramsey to the T. Again, I'd like to thank Wealthfront for being today's video sponsor. Since I love talking about credit and Dave doesn't, learn more about when to pay your credit card bill over here. I'll see you guys over there.